Welcome back to Trading Club 7U. I am excited to dive deeper into how financial markets actually work. In our last lesson, we touched on the basics of trading, but today we're going to go a step further and explore the inner workings of financial markets. So, have you ever found yourself staring at a stock price, wondering why it seems to be floating aimlessly, without any rhyme or reason? The truth is, financial markets are a massive, global auction system. Imagine you're at an antiques market with thousands of buyers and sellers coming together, all trying to agree on the price of a beautiful vase. That's essentially what's happening in the financial markets, but instead of vases, we're dealing with stocks, commodities, and currencies. Now, let's think about how these auctions work. When you place a buy or sell order, you're essentially making a statement to the market, either I want to buy X amount of this asset at this price, or I'm willing to sell X amount of this asset at this price. The market then responds by adjusting prices until someone is willing to meet your terms. This process happens billions of times a second, all day, every day. Let's take a closer look at a simple example. Suppose the price of Apple stock is currently at $150 per share, and you think it's about to rise. You decide to buy 100 shares at $150 each. If the stock price rises to $160 before you can complete your trade, you can now sell your 100 shares at $160, making a profit of $100. But if the price drops to $140, you'll make a loss of $100. Now, here's where things can get tricky. Beginners often make two common mistakes when it comes to understanding how financial markets work. First, they assume that the market will always do what they want it to do. This is a recipe for disaster. The market is unpredictable, and no one has a crystal ball. Second, they get emotional about their trades. They might get nervous and sell at a loss, or get greedy and hold on too long. We see this all the time, and we often call it the fear of loss and the greed of gain. Let's discuss these emotions in more detail. Imagine you've just placed a buy order on Apple stock at $150, and the price starts to rise. You might start thinking, wow, this is a great investment. I am making money. But then, the price keeps going up, and you start to feel like you've lost control. You might start to panic and decide to sell at a higher price, even if it means losing some of the profit. This is an example of the greed of gain. On the other hand, let's say you've placed a sell order on Apple stock at $150, and the price starts to drop. You might feel a sense of unease and think, this is a disaster. I should have sold sooner. But if you sell at a loss, you'll be locking in that loss. This is an example of the fear of loss. Now that we've seen these common mistakes, let's talk about how to avoid them. The key is to develop a clear trading plan and stick to it, regardless of how the market is behaving. This means setting clear entry and exit points, as well as risk management strategies to minimize your losses. For your homework exercise, I want you to open a demo chart or paper trading journal and set up a hypothetical trade on a financial instrument, such as Apple stock or the Eurust currency pair. Try to predict the price movement over a short period, such as a few hours, and see how it changes when real-world events occur, like news about an economic indicator or a company's earnings report. Remember, trading involves risk, and there are no guarantees of profits. Practice trading on a demo or paper trading journal before risking real capital. Our goal here at Trading Club 7U is to educate you and help you become a responsible and successful trader. Before you start trading, I want to remind you of another important concept: market hours and news cycle. Market hours refer to the times when the markets are open and trading is active, typically Monday to Friday, 9 a.m. to 5 p.m. EST. The news cycle, on the other hand, refers to the times when news is released, such as economic indicators, company earnings, and government announcements. These events can cause significant price movements, so it's essential to stay informed and adapt your trading plan accordingly. That's all for today's lesson. If you're just joining us, I recommend going back to Lesson 1 to get the full context. Don't forget to subscribe to our channel for more lessons and updates on the world of trading. In our next lesson, we'll cover the importance of risk management and how to set stop-loss orders. See you in the